So today's cardinal lesson is talking about tax rates, tax brackets for 2021. And our focus here is on retired folks and retired people, people over 60, 65, 70, 75, and planning for this year and future years to pay in federal and state income tax. So I want to call your attention to the brackets for 2021, but I want to start over here and explain this standard deduction. So when the Tax Cuts and Jobs Act in 2017 went in effect, this was a huge change that I have many clients that still don't really get this. Okay, so if you're over 65 and you're a married couple, your standard deduction is $25,100, and then you add to that $1,350 because you're over 65, so it's like $26,000 is what you can just put down as deductions on your tax return. So when you add up your mortgage interest, the taxes you pay on your residence, your charitable contributions, most folks don't fall in where they can deduct medical expenses, but that's a possibility. For many retired people, it adds up to way less than this. And so they're busy doing all this bookkeeping and sending all this stuff to the tax person when they're just going to take the standard deduction anyhow. For a single person, that's $12,550, and if they're over 65, it raises it up to about 14 grand of just standard deduction. So if your deductions do not equal that amount, or anywhere near it, you can basically quit keeping track of all that stuff. Okay. Now, where do retirees get their income from? I mean, most of them have a Social Security check. If they're a married couple, they got 2 Social Security checks. And the Social Security does not count in these tax brackets. Okay. You are going to have to pay some tax on your Social Security income, but it doesn't count in these tax brackets. So let's just say that a married couple has like $40,000 a year in Social Security income. And then they have another $30,000 a year of other income. So between the two sources, they've got 70 grand a year to live off of. Now, when you take that, you'd say, well, these people make $70,000, which they do, but for their taxable income, the only thing it counts is that $30,000 in addition to Social Security, or separate from Social Security. And then from that, the standard deduction is taken. So it brings their actual income or their taxable income down to like $5,000. So it's it's just people, many times I find, are not really where they think they are on these tax brackets. And you really don't have to really wait till you do your taxes to learn all this, as some of you might not be interested in really a lesson in all this, and I don't really want to try to get you where you have an expertise like me. I just want you to understand how the game works. So as we plan, the couple that I just described is not going to pay a lot of taxes, and they're not going to pay a lot of taxes on their Social Security either, just because of the way that's all figured. Now, so the only thing that's driving this number right here is these brackets. Like the 10% bracket is your income after taking the standard deduction. And so you're in the 10% bracket, and where most retirees get their second and third incomes from are their IRAs or 401ks, as they've built up a balance and now they need to live off of it. And a lot of them don't take anything out of their IRAs because they just don't want to pay any taxes. When in effect, many of them still in their 60s or low 70s could take some out of the Social Security every year and out of the IRA and not pay much taxes on it. And they could take more than they've been taking and still stay in a pretty low tax bracket. And so consequently, when we sit down with retirees that have a good Social Security check and then just some other income, and they really could have even more, they are reluctant to do that. And many times we're going to recommend that they take out more just because it doesn't do much to their tax rate to drive themselves up in these brackets. So the other thing that comes into play for people, especially in their low 60s, mid 60s, late 60s, just retiring, is the whole idea of Roth conversions. So we get many people that are all excited about Roths. They got a small one that they started, but they don't want to take any distributions from their regular or traditional IRA until they have to at minimum distributions. And once we show them what a Roth conversion is, and we do Roth conversions usually over multiple years, and we use these brackets, whether they're married or single, to make a determination of how much we're going to do in any given year. And so, I just like people to take a look at these, to understand them. When you're working, you don't have this business of a Social Security check. I mean, all your income is taxable, and so you're just going to be in a different place in this, along with the standard deduction, than you were when you were working. And so we do this in retirement planning for folks all the time as we put together a plan for the future. Now, when I look at these tax brackets and I look at all the time I've been practicing, these rates are low. I mean, the 24% bracket for a couple has a cap of $329,850. And so if you've got somebody that is at $80,000 and they're at the 12% bracket, besides their Social Security or their other income, they're at $80,000, they can go and convert, $100,000 of their IRA money or $200,000 to a Roth, and it's not going to drive them in a ridiculously high tax bracket because these numbers are just low. They were made lower with the tax cut 3 years ago. I want to add something else, is that these are scheduled to increase back to what they were in 2016. That's going to happen in 2025. If there's no change in the tax legislation, it was baked into this law that these low rates only last until 2025. So just bringing you into some of our thinking and our planning, and when we're meeting people and we're looking at their income, their savings, their IRAs, their Social Security check, and trying to figure out a way for them to live off of this stuff, sometimes it makes sense to begin distributions earlier than you thought you would. Now, you've also got the advantage of long-term capital gains and qualified dividends tax. So that's going to be when if you sell a piece of property, or you sell a business, or you sell a stock that you've owned for longer than a year, you pay much lower rates on things you've held for a year or more, or that come as dividends on stock. So the rate can be as low as 0%. In other words, if a married couple and their joint income, just like as I described earlier, is less than $80,000 a year, their capital gains tax rate is 0%. So we have people that once we come in, that they'll sell some assets just because they can pay no federal income tax on them, or they can take advantage of a 0% capital gains rate. So that's about all I have to say about taxes today. I'm Hans Scheil. I thank you for listening.